In our strategy, we do not predict headlines. We track signals, sequencing, and probabilities as cycles evolve. Today's focus is a global funding signal most markets underappreciate. Japan rarely leads U.S. market conversations. But when Japan's funding conditions shift, global risk often follows. That tension is what we are watching here. We are reviewing a video that focuses on Japan's upcoming policy decision. The creator highlights why this matters for the US dollar and equities. Our role is to translate that argument into our strategy framework. Japan has spent decades with near-zero interest rates. That made it a global source of cheap funding. Capital did not just stay in Japan, it moved everywhere. When borrowing costs are extremely low, money flows outward. Yen was borrowed cheaply and converted into higher-yielding assets. That includes U.S. stocks, bonds, and other risk assets. These flows do not show up in one clean data point. They build quietly over time, and they unwind only when incentives change. If Japanese rates rise, borrowing becomes less attractive. The math behind those trades tightens. Some capital eventually looks for the exit. Japan is a major holder of U.S. treasuries. If demand softens, yields must adjust. Yields are the price of capital in the system. As long as volatility stays low, these trades persist. Markets can ignore funding pressure longer than expected. That is why this is a sequencing risk, not a timing call. In our strategy, this raises late-cycle fragility. It does not confirm a downturn, but it increases sensitivity to rate-driven shocks. Near-term, risk assets can still hold up, but the balance shifts if global yields trend higher. That compresses timelines later in the cycle, not the announcement itself, but what happens to Japanese yields afterward and how U.S. rates respond. We tighten exit discipline. We treat global yields as a higher priority signal. We reduce reliance on growth narratives alone. We do not flip the framework on one event. We do not assume a crash. We still wait for confirmation. If this kind of signal-based framing is useful to you, subscribing helps you stay oriented as conditions shift. We focus on mechanisms and sequencing so you are not reacting late. Quick note here, this is educational macro analysis only. It is not financial advice. If Japanese rates roll back down, this pressure fades. If global yields stay contained, risk remains manageable. Those are the lines that matter. We do not need to be early. We just cannot afford to be late.